Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of December 8th, 2024. And in this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007. And we are just entering December. And this is kind of the final countdown of the year. And so in this episode, we're just going to have a little chat about kind of what each of us are really looking for here for the balance of the year before 2025 rolls in. And are we looking at anything special? Are we looking to trade anything? This is the time of year that the historical Santa Claus rally begins. And so the question is, will the Santa Claus rally arrive again this year? But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper. Love to hear what you're trading. Love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up there, subscribe, and if you can't find it, let us know, and we will get it there. But let's hop to this week's content. Viper, welcome back to the show this week. I know you were here once and then you took off again for the holidays, but holidays are over. Well, at least the appetizer to the holidays, right? The American Thanksgiving coming up now on the balance of the year. We got our Christmas and kind of the New Year's and all of that stuff, and the long-standing mythical Santa Claus rally, which has historically been a thing that has shown up in the markets. And that's really the time between Thanksgiving and Christmas where the markets just kind of melt up as we approach Christmas. And so, we'll get on into a little bit of stuff that I'm looking at, stuff that I'm looking to trade, but where do you stand on your belief in the Santa Claus rally this year and historically?
Do I believe in Santa Claus? I mean, I would say I'm looking forward to this being another year of it. I feel like last year was kind of my first year because I don't know. I don't remember. What was that? 2022. I don't remember it being a thing. Now, I'm pretty 90% sure it was not a thing in 2022. Because that was the very first year that, end of 21 into 22 was just maximum market exposure for me, maximum, no more dabbling and just actually diving into stuff. So December 22 was definitely a year that I was like, it's going to happen because everybody says it's going to happen. And then, boy, it did not happen. So because of that, I think I underestimate how much it actually happened last year. And so, yeah, I think it's a thing this year because I'm starting to see, more than just the mythical, the mythical lore of it. I'm definitely starting to better understand the market cycles, given where we are in the current market cycle. It's hard for me to see that we wouldn't have it this year. 2022 not having it made total sense because that was the year of quantitative tightening, all sorts of restrictions, and yada yada yada. So yeah, I think I could see it being a thing this year. I'm not actually playing anything for it, though I guess I am taking a slightly more relaxed approach. So maybe that does mean I'm playing something for it.
Yeah, this year I'm kind of on the fence about it, I guess. The biggest thing for me is how sharply we arrived at where we are. From basically the U.S. elections came out, and it did not drag on forever. It was pretty decisive, and the markets really just kind of took off to the races from there. At least the stuff that I kind of look at, which was more the Russell, which did hit a lot more gains than the S&P. And it kind of feels to me like everybody got real excited from the elections market-wise, and then they kind of front ran everything is where my gut tells me. But I don't really know. I mean, the price action is kind of interesting to look at. I'm not the expert price action tracker guy, but I did kind of notice that the Russell, and I kind of talked about this on last week's show, kind of went up to all time highs and backed off, and then tried to hit it again and kind of got denied again. And so part of me wonders, can we really melt up from here? And I don't know. I guess I kind of doubt it a little bit, but I also know that there's this saying that goes through the back of my mind. I'm wondering if I'm doubting it, right? Because I have certain trades on that are, a little bit, they'll go more favorable if the market kind of comes back in. And it's echoed in my brain, the markets can stay irrational longer than you can stay liquid. So I don't know. You mentioned in there that you're just kind of relaxing a little bit here as the year winds down. Does that mean you don't really have much strategy, crypto or equities there as far as what you're watching, what you're looking at? Is there anything you're hoping to squeak in towards the end of the year? Any tax loss harvesting that you're looking to do before the end of the year, or any sort of moves?
I mean, good thing, I guess. Not a lot of tax loss harvesting opportunities because of said rally that you were talking about, because that certainly hit all spheres, hit the equities, hit the crypto sphere. But I think one thing that I just I don't know what to call it, an aha moment, if you will, today was, I was like, hold on, pump the brakes. Um, I was catching my emotions, and so I was catching a behavior pattern, because things have been really good in the markets on positions that I've had open for the past, I would say the past potentially 5 months, 5 or 6 months, certainly the last three. So what I realized I caught myself doing was, as those positions were doing better and better, I was hitting profit targets. I was, closing partials of the orders or whatnot. And I was finding myself taking that and immediately rolling it not into the same thing, but rolling it into something else, rolling it into another play. And that's why I started to catch myself today of like, hold on a second, like this is how this is how bad things happen, because I'm not taking the time to, like, on one sense, people, you could be like, oh, you're realizing profits because you're hitting those TP orders, and but you're not really taking profits if you're hitting those and then immediately rolling that into another position, because then you're keeping it on the edge. And so when we hit, I mean, like you said, big upswing we have, there absolutely is a pullback at some point. Always is. Doesn't mean it's a bear market. It just means it's a pullback. It's a correction. And if you're constantly riding that edge, then when that happens, you're no better off than if it happened today. So I took that a lot to heart today and hopefully realized it just in time. But that's probably what I'm going to focus on the rest of this month. Ironically, to everything I just said about believing in Santa Claus, is first of all not doing that anymore, and second of all closing out some additional positions, and still having some profit targets set on other positions, and when they hit, let the profit lock, if you will, and actually start trying to get more into that habit, because it's one of those emotional things of things are going well, things are in profit nicely, so you can get wrapped up of like, now let's go do something else. Now let's go do something else. So definitely trying to acknowledge that cycle and take proactive steps to stop it before it becomes this is what I should have done scenario.
Yeah, it almost sounds like a measure twice, cut once type of thing, where it's don't just kind of jump into it. Kind of stop, pause a little bit, pull back, think about it, and set up, and not just kind of jump to jump. So then that makes a lot of sense to me. For me, as far as the stuff that I'm kind of looking at, I'll say that I'm not really too anxious to start anything new here as the year winds down. I have one kind of strategy, and I guess it might be a little bit around tax loss harvesting. And what I'm kind of looking at is, as you know from episodes ago, I've made a transition now for about a year into a new brokerage account, Interactive Brokers. So that's kind of the broker that I use for the bulk of my trading. Previously, I used TD Ameritrade, which later became Schwab. Still have that account. I still use that for. I still use that brokerage for a lot of my IRA work, a lot of my retirement accounts, other things like that. But for my daily trading, I have found Interactive Brokers to be a little bit more in favor for my style as far as margin rates and as far as trading commissions on things go. As you know, I do a lot of options, and those are not free from fees and commissions. And Interactive Brokers just had a much more attractive rate. Additionally, Interactive Brokers has a way better margin rate on the margin that they'll extend you. And so I've been moving over to that, but I still have a significant chunk of funds sitting in my Schwab account. And what I've been doing is, for reasons I won't explain here, I can't do a portfolio transfer from my Schwab account to my Interactive Brokers. So what that means is I kind of have to wind down my positions in there. And I'm really starting to go through some calculations right now to say, you know what, is it worth it just packing up my bags and selling out of a lot of the positions that I have over there? Notably, the stuff that's kind of laggard in there, if you go to my Theta Gang, I have gotten assigned years ago now. Like I think some of these things I've held for 2 years, a year and a half plus of just absolute duds. So when I was going into a lot of my premium selling, one of the things that I was kind of doing is selling premium on anything. Anything that walked or crawled or spiked in volatility, I sold premium against it. And that's one of the lessons I've learned over the years is, hey, that's not so smart to do if the underlying company, might not be profitable. Because once that kind of meme stuff evaporates, it kind of goes really low. And at that point, my position sizing was always small, so it never consumed a huge amount of my portfolio. So I thought, oh, well, I'll just, roll this, and it'll come back. Well, it's kind of come back, but not anywhere near my cost basis. And so I probably have 3 or 4 positions over there that are extremely low. Let me think of one, Lazar or Lumineer, I think. LAZR is the ticker. They do like driver assistance stuff, and it was all the rage in 21. And it's basically a fraction of its former self nowadays. Plug Power is another one that was just rocket fuel and now is like pennies. Not really pennies, but not much of anything. And one of the things I'm looking at is, and I'm not a tax professional here, so normally when you go do your capital gains, your short terms offset your short terms. So for example, if you have short-term gains and short-term losses, you add those together, and your net benefit is your short-term tax credit or tax obligation, I should say. Well, I kind of said, well, what if you don't have any short-term things to weigh against, right? Like what happens, or sorry, what if your long terms, you balance them out and you're negative on your long term? Can you use that to burn down your gains on your short term? And that's kind of what I'm researching right now, saying, you know what, these things are probably never coming back, or at least not coming back anytime soon. And there's enough of them over there that maybe it is beneficial to just pack up those things, book those long-term losses, let it count against my short-term gains, because my short-term gain, my short-term for this year is very, very much positive from a capital gains perspective. So lowering that tax obligation by subtracting off those longer-term losses from it is definitely something I'm really looking at. Then the other stuff that's kind of going on is, as you know, some of the recent episode, I played a lot of earnings on different things. A lot of them were winners right away. Some of them got busted and went into a management cycle. And my management strategy is always to roll them out to the next monthly expiration. And so I'm, kind of watching those plays, which all expire now. At least the ones that I managed, rolled them into December, which is the monthly expiration of December is December 20th. So that's kind of the last area of trading that I have on my target, and it's really not opening up new positions, but kind of getting ready to hopefully pack up and close out some of these managed positions that I have rolled out. And the majority of them are looking like they're going to close out for winners as part of that management. There's maybe one or two of them that will probably get rolled again, or I'll get assigned on. I'm not sure which. That will either be shareholders or rolling forward into January. But I can't say that I'm really looking to enter the market in very many plays, simply because I really take the volatility selling aspect of things. And kind of when you're up at all-time highs, the volatility is not necessarily elevated. Sometimes I can get a nice strangle on because once you get at all-time highs on something, you can get pretty good volatility because it's kind of untested territory. So there's a lot of unknown, and volatility kind of inflates for that. And so strangles are kind of safe because you get that short on the top side, and you probably have enough interest in the stock to kind of pick up a crash to the bottom side. So I've had pretty good luck in my tracking of trades of opening up strangles when we're at kind of all-time highs for a particular underlying and extended volatility. But I can't say that I'm really going out of my way to find some of those trades. Ideally, I'll kind of be reflecting on the year as far as the different things that worked. So I'll go through my trade journal, check a lot of those things, and figure out what changes am I going to make, if any, as we approach in January, and then really try to work down that Schwab account to close out those positions, and then roll that capital into Interactive Brokers, and then really start going on the hunt in January after the new year.
Yeah, I think there was something you said. There was another kind of perspective I had today as far as what I was referring to before about not constantly just rolling forward into new plays and whatnot. And at risk of just restating what I said before, but another perspective, if it helps, especially newcomers or people that maybe entered beginning of the year and find themselves in positions that might be in profit or whatnot. The other thing that I realized today was exactly what you said, of not entering, or certainly not chasing entering positions, period, whether it's coming from rolled off profits or it's just brand new capital. Because number one, obviously, don't, I think we did it on this show, don't enter the market at the top, or at least if you do, know where you're entering, know the risks of how you're entering, and risk mitigate on your position sizing for how and when and where you're entering it, and all of that good stuff. So now that I've been so active for the last 3 years through the bear, that was the other realization was, don't, and so now I'm not talking to newcomers. Now I'm talking to people that might have been around a while and had these positions accumulate. That don't waste that time. Don't waste that effort by continuing to edge new positions. Let the thesis of those trades play out, because there's a good chance that invalidation on them hasn't happened yet, because we are breaching new all-time highs. So you worked really hard, and this is me speaking to myself, certainly. You worked really hard to put these positions in place. Don't ruin it by chasing all-time highs. Let the thesis play out. Keep your eye on the invalidation. Keep your eye on when you need to fundamentally close a position, and be satisfied with that. Be satisfied with the full cycle of the play. And that's certainly where I'm at in the journey is really trying to focus on sharpening these mental and emotional nuances of it. And again, if you're new, this is just kind of a unrelatable warning, not even warning, but just lesson that, is good to have in the back of your mind. But your focus as a newcomer is that mitigation of risk, especially when things are steaming at all-time highs.
Yeah, actually, what you said there, I got a question for you on your perspective of things, because I too, early on in my trading career, was always very anxious to be in the play, right, in a play, and I found that caused me to enter some things without the proper strategy, without I've kind of see things that weren't really there or force myself into something. And in the back of my head, when I was doing a lot of that, there's the whole time in the market beats timing the market. That whole adage that goes on, which there's a lot to that. But one of the things I've found more recently, and I don't know if this is a byproduct of just my trading maturity or if this actually is a byproduct of your account size. Because I started everything with $2,500, and I've slowly grown it over the years. And there's like this mentality that when my account size, was in the $2,500, $10,000 range, something like that, right? I have these trades on, and these trades were yielding, $80, $200, $300, right? And the aggregate of all of those never seemed like enough, right? And so I constantly wanted to put more and more on, or have it 100% utilized all the time, because if I didn't, I just felt like I was wasting powder, wasting an opportunity. And more recently, my account size is a little bit larger. And so I can put on a set of trades, and there's like this mental number that my monthly profit from my premium selling is bringing me. And I'm like, yeah, I'm comfortable with that. And I don't feel that anxiousness of wanting to put more and more volatility trades on, where I'm having the ability to sit back and look for the right setup on my strategy, right? Look for the right volatility and then pounce. And I don't know if that is more so just my experience of learning that that's better because, I went into haste a lot of things, and haste makes waste. And but also I'm content because my positions are a little bit larger, same percentage of my portfolio size, but that number coming in each month is more okay in my head. I don't know if how you feel, or if you have similar struggles or similar effects on your journey.
I would definitely say similar, and I would equate it to a couple different things. One, certainly, like you said, when the number, when you have a we'll say grounded or realistic, aka not moon boy perspective on the markets, and you're truly looking for steady growth, then I certainly think there's that factor of it, like you said, that there is a number for everybody. Again, from that pragmatic, realistic perspective, there is a realistic number for everybody that just feels appropriate, and I would say that number is probably even relative to your general income. So the income that you're familiar with on a month-to-month basis, you contextualize against that number. And so if your monthly income is $4,500 and you're making trades that are pulling in $200 a month, then you're going to contextualize it against that. Um, so I think that's certainly part of it. And I've kind of had that feeling as well. But I think for me, more than anything, is I still had the same journey. So I started small with a small entry. I wish I could say it was a well thought out plan to start with a small entry due to being at the market top, but it really had nothing to do with being at the market top. It was a small entry in the account size purely from I don't know what I'm doing. I need to figure this out slowly, which is still perfectly valid. It just happened to also coincide with market topping when I made my official entry. Um, and then I was never in a rush to increase position sizing. And I did that. And by that point, I realized we were going down. The ship was going down. There was really no need to bring in a whole bunch more money. It was more of like everything keeps being red. I should not bring more money in here because things keep going red. And so I kind of learned to survive on the downward slide through the bear and all that sort of stuff. So fast forward now and things are going up and the account is getting bigger and very similar trajectory to what you were saying your situation is. And I feel the same comfort. I feel the same. I mean, comfort. I guess comfort is appropriate, but I would also say confidence. Where just the other day I was having a conversation and I was like, it's crazy to think about position sizes that I had a year and a half ago and how insanely huge they felt, and then comparing that to position sizes now. And that doesn't mean I'm blowing up a much larger proportion of my account. It's just it comes with the account growth, but it also comes with that confidence of knowing the mechanics inside and out of whatever it is I'm trading, whatever the play is. And I think to your point, as far as not feeling the urge to chase, I would equate that, at least for me personally, to be relative to again, that confidence. And in the early days, that drive to chase was learn. In my case, it was, I want to do that again because I want to feel this slight knob twist and see what happens. Or, okay, I just observed it did something unexpected. Let's go do it again and see, and then account for it in a gamified way, almost, of like, all right, the game changed, so now let's run it again and account for that little tweak there. And that's just experience gaining. So I feel like it's definitely, I feel I have the same experience, and I would relate it to that gamified mentality of, in the early stages, you're trying to get all the different angles figured out. Now, certainly not saying we have all the angles figured out, but we do have lessons in our pocket, and that is directing uh, uh, where the focus is, and things like that. So I would I would equate it to that. And again, speaking to newcomers, this is also why I will always massively stress risk management, position sizing, because if you come in red hot and just start YOLOing around and throwing money on everything, you're gonna burn out. I mean, literally burn out of your cash, and it's just not a good idea. And it's much more enjoyable because I there's parts of the journey I wish weren't as hard as they were coming in on the downslide, but I am very thankful for that risk mitigation, for that position sizing, because it really allowed that repetitive churn to learn those lessons.
Yeah. And keeping it a little bit newcomers focused, I think one of the very, very important things to look at is look at all of your gains, look at your position sizes, look at your losses in a percentage capacity relative to your net liquidity or your portfolio size or your cash in play. Because I think it can be discouraging because you hear about, oh, so and so got, went up $5,000 today. Well, so and so might have a portfolio of $200,000 or $500,000, and so that might not be that big of a percentage upswing. And I was reviewing with one of my kids over the holidays some of their performance of stuff that they had kind of put in, and they were kind of like, oh man, I'm only up $200 on this thing, and I'm like, yeah, but that $200 is like a 40% gain. Like that's huge, and like you can't be sad about that. But it's this whole like absolute value thing that gets looked at, and I really want to encourage you to do everything in a percentage basis and your position sizing that Viper's really talking about. It's a what size relative to your portfolio. You should be kind of entering in a 1 to maybe 2.5% of your total portfolio as a singular position size. And that's what gives you longevity. That's what gives you flexibility. And don't be sad when that position size, says, oh, look, I went up $20. Well, that $20 might be, 25%, 15% over a week, over, whatever short time period. And now just remember, a savings account, right? The base case interest rate is what, Viper? 4.5%, something like that, a year. And so you have to kind of always put some of that stuff in context and not get discouraged, because I know I personally was discouraged on the smaller account sizes because that dollar amount that you go up doesn't seem like that much, but on a percentage basis, it can be.
The last thing I'll say, because I do want to hound the point, is, exactly like you said, as far as percentage and all that kind of stuff, is that mentality shift of if it helps, because I have this conversation with people in multiple arenas, in multiple places. So another way that I like to think about it, and this is a really, really gamified mentality, what I'm about to say. So I don't like, for you, Sprocket, I don't think it necessarily applies, because you have that more rhythmic pattern to your stuff. But if you're more of a gamified mentality, the reason that we talk so much about rigid structures, risk to reward, 4-to-1 ratio, all that kind of stuff, is think about it, of every time you take the 4-to-1 risk to reward ratio is what I'll refer to, which means you risk 1 unit in order to gain 4 units. And so we talk about it on other episodes, can talk about it again, let us know. But the whole point of it is, why wouldn't you take that, only take a trade when that is potentially what's on the table? And the gamified way to think about that is, for every win I take, I can now, quote unquote, afford 3 losses, and I will still be where I started. And so, I was talking to somebody, and this perspective really clicked with them. And so I was like, look, as long as you're using a rigid structure of risk management, tolerance, all that sort of stuff, position sizing, every time you take a win, put down like 4 or 3, whatever the ratio is, put down 3 or 4 L's, log them, and that's in the bank now. You have losses in the bank that you've credited yourself for. So when you take a loss, you don't need to freak out about it, because look at your credits on that sheet. I took 1 win, I can afford 3 losses. Next time I turned around, I took the loss. Oh, well, that's okay. I still have 2 losses. I still have 2 lives in the bank. So, stuff like that. I mean, that's why the idea of, what you were talking about as far as position sizing and all that kind of stuff, and that structure is really important, because you can, that's the only way to build momentum going forward.
Yeah, for sure, Viper. Totally agree with that sentiment there, and I think that's a good way to think of it. And you don't, in what you kind of laid out there, is you can actually lose more than you win and still be profitable, and that's something that I think takes a little bit to get used to. But when you do something like that and you stick to a system like that, you don't necessarily have to have the winning record. You just have to get the strategic wins and not haphazardly burn through your losses. So that brings us to the end of this week's episode. Like I said, this is kind of just a reflection as the year is kind of winding down. What's on the horizon for Viper and myself, and what are we looking at? And generally, I think it was kind of funny that we have a similar perspective of, the end of the year is coming, and we're not really anxious or really jumping out there to tear into anything. We're going to kind of let the market kind of play out. There's some trades that we're letting unwind and wind down. We're going to keep our eye on certain things, and if the right setup comes in, we'll have the patience to wait for that setup and then take it if it aligns to our personal strategy that we like to deploy. But other than that, it's really kind of positioning ourselves for next year and really getting ready to hit the markets from come January and the new year and see where some of that stuff goes. So hopefully you guys are experiencing good luck out there in the market. Like I said, it's really been quite a melt up so far since the U.S. election, and that some people say the trend is your friend. So it likely looks like this trend will continue. But good luck out there, and hope you're finding the stuff that fits your strategy. And don't forget to always think outside the block.